Right.
Okay, guys, why don't we get started? We have I'm kind of nervous because there's 1,000 people in this room here at Coldwell Banker Dynasty, and I got all you guys on Zoom. Can you guys hear me okay? Just wave or something. All right, so I'm assuming you guys can hear me. So we're going to talk about reverse mortgages today, and I'm Scott Shimamoto with Journey Mortgage Advisors. We're a broker, and I've known Coldwell Banker Dynasty for a long, long time. Anyway, I have a sponsor today, and it's this. Because there's so much.
Is that you?
I don't know. I don't know if you guys can hear that, but that's a commercial I've been running on. It's been on Monday Night Football, and yeah, it's been running a lot. So it was a lot of fun making that. I didn't make a lot of money, but had a lot of fun. Now I gotta turn it off. Oh, sorry. Okay, I'm gonna screen share again. Hey, Connie. So try not to hang yourself on this. Yeah, there's
Pretty good.
wires all over the place. All right, I'm gonna my other person I do business with here on the call with us is Angie Tang, and we're talking about seniors. And Angie has the ability to do what do you call it? Farms for seniors for this age bracket we're going to talk about today. So if you guys need that, yeah, get a hold of Angie and she will help you out with a farm. All right, let me share this other screen now. All right, can you guys see my screen?
Yes.
Okay, cool. Why is it doing this? All right, that's what I want. Okay, so we're going to talk about reverse mortgage today and how to generate 3 transactions using reverse mortgages. And this is a beautiful thing. If you can figure out how to do this with me, you can make some good transactions. All right, so who needs to make more sales? Everybody, right? So right now it's time to think outside the box. And this is one way to think outside the box and be outside the box and give your potential clients something different, because everybody's saying that they're the greatest realtor, that they did this many transactions. But, if you don't have that, if you're not the number one guy, no matter what, everybody else is number 2 or lower, right? So in this case, if we talk about what you can do to help your clients out, then that is going to be really, really great. And you can do something that's different. So when they see your postcard or whatever, it's different, or your social media. All right, so the facts, there are more seniors than ever. I think you guys know about the baby boomers. This is the biggest market opportunity going right now, because there's just so many. As of 2016, there were almost 75 million baby boomers, and there's more now. And roughly 10,000 people are turning 62 every single day. So the viejos like me, we're getting old. Okay, other thing, many seniors want to downsize, and many seniors want to help their kids buy houses, right? I think we know this. Oops, okay, so a lot of seniors that are house rich and cash flow poor. A lot of reverse mortgages can be used. Reverse mortgages can be used on their current home, and I'll tell you how all this is going to work. But I'm just giving you some facts about this. And a lot of people don't know this, but you could buy a house with a reverse mortgage. I'm having a weird time because I'm trying to present here and I'm trying to present to you guys at the same time. So if I'm looking here, it's because I'm looking at my notes too. Okay, so the last point, you guys want to help your clients and you guys want to generate more sales, right? So this is a situation where it's a win-win. You could do both. Okay, so how to create this is the bottom line. How to create 3 transactions using a reverse mortgage. Okay, so this is going to happen when you have a senior who has a lot of equity in their house. And they can do this. They can help their kids buy a new house. If they do that, they can potentially create 3 transactions. The first one is, okay, one thing they could sell their house, get the proceeds. You get the listing. They could take part of the money, give it to the kid for a down payment on another house. They could take the money that's left over. They could go and buy another house with a reverse mortgage, and then they won't have a monthly mortgage payment. So that'll make them happy. And then they could also take, if they stay in California, they can keep their property tax base. So that's one transaction. That's the first transaction. And these other ones, the same thing, right? You could also, I already said that. Okay, okay, I said all 3 of those. Sorry, I haven't done this presentation for a while. But that's 3 commissions for you if you do it right. Okay, now sometimes a senior, they want to stay where they're at. They don't want to sell their house, but they have a lot of equity, but they want to help their kid buy another house, right? So what you could do with a reverse mortgage, you could pull a bunch of money out of this house, and then they don't have a monthly payment on this, so they're happy about that, right? But they could take this money and then they could give it to the kid to buy, for the down payment to buy another house, right? So at least you can get 1 transaction out of something like that. Or if they have, a lot of equity, they might have more than 1 kid. They might be able to get a couple of different transactions out of that. So in this case, you can get the purchase transactions. And I could help you obviously with the loan. Yeah. Whoops. Okay, sorry. Okay, so what is a reverse mortgage? You have to think when it's reversed, it's like everything's the opposite on a reverse mortgage than a regular mortgage. You just have to think, you have to just forget about regular mortgages, because some of the things that are good on a reverse mortgage are bad on a regular mortgage and vice versa. But the reverse mortgage, it's available to people who are 62 or older. And then it helps them convert their equity in their house into cash, right? So like I said, someone might have bought their house for 20 grand, 40 years ago, and now it's worth $1 million. But they don't have any way to access that unless, like in a non-reverse mortgage world, you have to do a cash out refinance or something to get the money. And a lot of times the seniors, they're not working anymore or something, they can't qualify for the loan. And I'll tell you how we'll get into how they qualify for a reverse mortgage. Okay, so there's no restriction to how the reverse mortgage proceeds can be used. So in other words, they could go, if they wanted to, they go gamble in Vegas with it if they want, but we don't want them to do that. But they could use this money any way they want. They could use it for living expenses. They could use it, like I said, to help their kid buy another house. Or if they want to buy another house and like as a rental, they could do that, get the down payment, put it on the rental property. If they can't qualify from an income standpoint, that we could do one of those debt servicing loans where you use the cash flow from the new property to qualify for the loan. So there's a lot of ways that you can make this reverse mortgage thing work. But the bottom line is the reverse mortgage is going to allow the senior to tap into this equity that they have in their house, which right now they can't do it. So instead of making monthly payments to the lender, like on a regular mortgage, they don't make any payments. The interest is added to their principal balance. So let's say they pulled out $100,000. Okay, so instead of paying, like $800-900 a month for the interest part of that loan, what they're going to do is they're going to just add that $700 or $800 to the principal balance. So month 0 is 100,000. Month 2 is 100,700, and just keep adding on and on and on. So because of that, there's no monthly payment. So then people say, well, is that a good thing? Well, maybe or maybe not, right? If they need the money now to live, then it's a great thing because now they're kicking that obligation down the road. They can still get the money they need to live. Or, like I said, they could help their kids buy another house or 2 houses, and then they're building wealth, right? And the beauty of this is this next point, the borrower is not required to pay back the loan until the home is sold or otherwise vacated. You must live in the house if on a reverse mortgage. The senior must live there. So again, they're not required to make any monthly payments. They could if they want. Like if they hit the lottery and they want to, not have this interest accrue as much as it has been, they could put it towards that reverse, towards the balance and lower the, the interest payment and stuff like that. But they don't have to. They do need to remain current on the property taxes and homeowners insurance and if they have HOA. So okay, let's keep going. Okay, so again, how come there's no monthly mortgage payment? Again, it's the opposite of a regular mortgage where you have to pay principal and interest down every month. In this one, you don't have to pay it back. So they could just sit on it forever and not make any payments on the loan piece of it. Okay, so this last point about they keep on adding interest to that principal balance. So then the question becomes, well, what happens if you keep on adding interest to that principal balance and the balance goes from 100,000 and it goes to 500,000? And let's just say the house is only worth 300,000 at that point. You could just give the house back to the lender. Okay, all the risk is on the lender. It's kind of like when you lease a car, they have this thing called a residual payment at the end of the, like say it's a 4-year lease. If at the end of the 4-year lease, let's just say the residual payment is 20,000 and then the car is worth 30,000. Well, then you could go sell that, you could sell the car for 30 grand and then just pay the bank, 20,000 back, you made 10 grand, right? Or if it's upside down and let's say the car is worth 10,000 and the residual to pay it off is 20,000, you just give the car back to the dealer, right? It's the same thing with this on the houses. So you can't lose. Go ahead.
Thank you for that, Scott. So does this affect your credit in any way, shape, or form?
So the question was, if you give the house back and you're upside down, does it affect your credit? Okay, so the answer to that is no, because when you're going to give the house back, first of all, the person on a reverse mortgage, he passed away, right? So then you don't have to worry about credit in that kind of situation.
So what if the person has not passed away and it is on the first mortgage and they're using the property as an ATM?
Then no, it's not gonna affect, because okay, so they have these the people who determine how, they statistically how long people are going to live and all that stuff, all that's built in. So the chances of that are really low because they don't give you 100% of what your house is worth. There's a percentage of it. And so the chances are it's never going to get there. But it's possible that it could get there. Now, the other thing that people ask is, let's just say you did give the house back, right? And then like your heirs, what happens to your heirs? Are they going to get hit by it? And the answer to that's no. They don't get hit by it because they're not on the loan. It's like if I took a reverse mortgage out, if I ever have kids, my kids would not get hit with it because everything stops with me.
So that leads to this question. So if it's a reverse mortgage, could the title be in a trust?
Yeah, you could. Okay, the question was, can the title be in a trust? And the answer to the question is yes. The initial loan is going to be, it's just like a regular loan where it goes into the individual's name, but then they could put it into the trust afterwards. Yeah.
So there's no tax consequences if the house is given back at that point. To the heirs.
To the heirs, no, because the heirs they're not part of this. They're not, right. So that's a beautiful thing. But if there's equity left, then they get to take advantage of it.
How so?
So
if the property is given back.
Okay, now if the property is given back, that means we're upside down.
Correct.
So then they're not affected, right? But if there's equity still left in the property, then they can sell the property and they can keep that equity. So they don't lose out, right?
Okay.
So let's just say the house is worth $1 million and they owe 300,000 on the reverse. And let's just say, the person passes away. Okay, now the heirs, they own the house, right? It's $1 million house. They pay out the 300,000 and they sell it. And then You guys make your commission and then, you
So
know,
the money that is always paid out. It's
Correct.
Not paid out, it's the money. Well, yeah, that they paid out.
yeah, that the bank paid out to,
Okay.
yeah. Question? Uh-huh. Okay, so, all right, so we're going to talk about that, but basically it's an owner occupied product, right? So if the person has to move it, like if they go to a nursing home or they pass away and they're not living in, or they move in with the kids or something like that, then that triggers the lender to say, you must do something about this reverse mortgage, right? So it's either the kids, if they could qualify and they want to keep the house, they can refi it, you know, just pay off whatever, you know, is owed, or sell it. So during that time, most likely, you're probably going to be at about 60% loan to value. So you should have like 40% equity still, because they only allow you to take out, like, it depends on your age, but like say 60%, right? If it's $1 million house, 600,000 is what you could take out of it. And they don't let you take it all at once. Like it's 60%. And then there's like, you know, 80% of the 60% is what you have access to. Right. So, and the reason I'm being very vague about like those numbers is because we have this computer software and it depends on your age. And then we plug in, you know, the value of the house, we plug in your age, we plug in, you know, how much you want to pull out and all that. And then we're going to get into it, but how to pull the money out. There's a couple of different ways to pull the money out. But all that being said is it's one of these things where the risk is on the lender, not on the borrower. Okay, so why would someone want to use a reverse mortgage? They don't want to, you know, if they want to say they have a mortgage payment right now, they don't want a monthly mortgage payment, they could do this reverse mortgage. They want to pull money out, say they got a bunch of bills or something. I'm talking to a guy right now. He needs a new roof and he needs to buy a car and he's got some other debts, right? So, but he's not really working right now. So he's not going to qualify for a cash out refi, but he's got $1 million house that has like $100,000 loan on it, right? So I could help him pull out money to get him to fix what he needs to fix and take his mortgage payment away. Okay, so another way you want to pull money out, well, I said that. You want to downsize to a smaller house. You want to help your kids buy another house without impacting your own cash flow. And some people, they don't want to do any of those fancy things. They just want to make their assets last as long as possible. Like maybe they have, I don't know, like $300,000 in the bank, and that's what they're using out of the retirement to live on. And then their monthly mortgage payment right now, say $2,500 a month, and that's going to really make their money go away faster. So you could do a reverse mortgage, and then you could take that mortgage payment away from them and let their assets last longer. All right. Okay, so 2 types of reverse mortgages. The one where the senior stays in the house, and the other one is where you buy a new house with a reverse mortgage. Some people don't have a house. Some seniors don't own a house right now, but they have a lot of equity in like a retirement plan or CDs or something like that. And they do have enough money to make a down payment, but they can't qualify for a new loan for a new place. So what they could do is they could take the money, use it for a down payment on the new house, and then use a reverse mortgage to make up the difference. Probably have to put about 40% down, and then, but they could buy one. Like, and seniors, like a lot of seniors are going to like Sun City or these places where they have retirement communities, and the property values they're not like millions of dollars. Maybe it's like 500,000, and they have like a couple $100,000 in the bank. Well, they could go ahead and use that money for the down payment, get into the new place, and then have no monthly mortgage payment. They have to pay property taxes and insurance, but they don't have a mortgage payment. So for them, it's probably going to be better than rent. And then they're also building equity too, you know, depending on how they handle it, because your interest is something, but your appreciation is probably higher than the interest. So it might work out that way. Obviously, no guarantees on that. But maybe not in this market, but 10 years from now, if they buy it now, there's a good chance that they're going to be, way to the upside, building equity. And then they're protected also against rent, rent increases. All right, so how much money can you get? Okay, so I want you to look at this chart. This is just the numbers if you're trying to buy a house, and this is just, I haven't seen an updated chart, so that's why this chart's a little bit old. But if you go, like the senior's going to like Sun City or something, they might be able to buy a house for this amount of money. But okay, so let's just take the purchase price of $465, and let's just say the person was 75 years old. So what this is representing is how much down payment would be needed to buy a $465,000 house. So if you're 75 and you were trying to buy a $465,000 house, you would have to put $237,000 down. But if you look to see if they were 62, then down payment would be $273,600. The reason why, the older you are, then the less money you have to put down, because your life expectancy is shorter at that age than if you're at 62. And this is what the people, they're called actuarials, that they look at statistics to see how long you'll live and all that good stuff. But we plug all these numbers in again, and what we do is we look at what your client's trying to do and what they have access to, and then we plug all the numbers in and see what they actually would qualify for. But you kind of get a feel for, they're putting like 40% down on these deals. Any questions? Okay, at the end of this thing, you're probably gonna have all kinds of questions too. I'll answer questions for you more specifically, like later when you have an actual live client. I'm just trying to give you an idea right now. Okay, so how do you pull the money out? Okay, these are the 4 ways you could do it. You could do a line of credit. So in other words, you could say, I don't need the money right now in a lump sum, but I want to have access to it. So you could just have a line of credit, and then you just pull the money out when you feel like pulling it out. You could do a term payment, which is fixed withdrawals for a specific amount of time. So you might say, you know what, I want $5,000 a month for the next 10 years. And then we see if you qualify for that. Or we'll tell you, you want to pull money out for the next 10 years, you qualify to pull out $4,000 or $6,000. Or you could do a 10-year payment, which is you could pull X amount of money out for the rest of your life. So depending on the equity of the house, depending on your age, we're going to plug that into that calculator, and it's going to tell us, okay, well, you could pull out $4,000 for the rest of your life till you pass away, no matter how long you live. And some people go for that way. You could also pull the money out in a full lump sum. You could pull like all $500,000-$600,000 out at one time if you want, or you could pull out like $200,000, and then you can make a line of credit for $400,000. So it's flexible the way you pull the money out. And what's the best way? It just depends on what your client's goals are. Okay, so how do you qualify for this? I'm going fast because I know we're going to run out of time if we don't go fast. Okay, so how do you qualify? You got to be 62 years old. The reverse mortgage needs to be the primary lien. Can't go in second position. It needs to be a primary residence, and the borrower must be they need to be current on their taxes, insurance, HOA, etc. Okay, the borrowers are responsible for their own condition of the property. They need to maintain the house, and they need to do what they call a financial assessment. Okay, we can get into that more, but it's not qualifying per se. It's a financial assessment. It's not like bank statements and tax returns and stuff like that. Okay, also, they must have counseling by a qualified agent. The reason why is because there's a lot of predatory people who are trying to take advantage of seniors. So they need to make sure that whatever like the loan officer is telling them is actually true, and that the loan officer has covered everything with them, because they just don't want to have any fraud going against seniors. So this qualified agency, it's like an FHA approved counseling service. They charge like $150 or something like that, but they need to do this counseling before we can move forward.
That's a great.
It is a great service. Because, well, we're all in this real estate business in some way, shape, or form. We're all crazy in this room, but sometimes the people at that age, sometimes they're not, they're not as cognizant. Some have dementia and different things, right? So they also need to, like, if like, let's just say the kid is helping the parent, then they need that kid to be on board too, with the counseling and all that good stuff. They need to make sure they have power of attorney and everything else. And it's just to make sure that there's no hanky-panky going on. Because
One that I saw where there was hanky-panky, and then the senior said that he didn't know he was signing papers for a reverse mortgage.
bless you. So Sylvia made the comment that she had a client that that the senior did not know he was signing paperwork that he was going to get a reverse mortgage, and that's not good. That's not good. We need to make sure that everybody's on board, because even sometimes the kids will try and rip off the parents, which is really sad. But unfortunately, there's people out there like that. So we need to protect everybody. This is to me, this is even good in general. Like, it helps me because now I'm not competing against people who are just saying whatever the people want to hear. They need to understand really what the deal is all about. They need to know what they need to know, right? So it helps me because I tell people what they need to know, and sometimes other people come in behind me and say, no, that's not true. You can do this, this, and that. But what they're telling them is not true, and then the people get in trouble. That's not good. So, okay. Okay, so this is we talked about this a little bit. What happens at the end of a reverse mortgage? Okay, you could pay it back. You could sell it, sell your house and pay it off. And then we talked about where the equity goes. If you're upset it down on the property, give it back to the lender. If you have equity, then you can either sell it or you can keep it and then refinance whatever's owed. In that case, of course, you have to still qualify for it sometimes. If you're going to turn it into a rental, we could do that. The rents to the debt servicing loan, we could do something like that. But you can do something with it. You're not going to lose your equity. Yeah, so when you pass away, you got the death certificate, and then that triggers everything. Because my dad, unfortunately, my dad passed away. Wow, year and a half. Yeah, so when he passed away and the death certificate hit, it's on his Social Security number. So all his pensions, his Social Security, all that stopped. And then all the life insurance company, they all got alerted. And then so these guys are going to get alerted too. And then not living in the house, I'm not sure what triggers that, but I guess if they move into a nursing home or something like that, it could trigger it. But I get the calls. I get the calls after the fact. Like, someone will tell me, yeah, a reverse mortgage company, he told me that we have to pay it off. They give you a year to figure out what you're going to do with it. And yeah, so they're asking me, yeah, this is what's going on right now. And they go, how'd you hear it? Well, they just called me. They got a letter and stuff. So, all right, let's go to next. Okay, so what is a financial assessment? I was talking about that, how you qualify for this. All right, so the financial assessment, they're not looking for your income. They're not looking for, what I mean? They're not looking for stuff like that, from pay stubs. They're looking for it. Are you getting Social Security? Can you cover your taxes and insurance? They're looking for, are you a seriously bad 350 FICO score? Something like that. You don't know how to handle money. They're looking at it holistically. But they're trying not to deny these loans because they know that the seniors, they do have access to this equity, but they do need the money too. So, but let's just say this, 1, 2, 3. The fourth thing, this thing they're talking about a set aside. sometimes the people don't have really enough money to pay their taxes and insurance. So what they do is, depending on their age and all that good stuff, they'll say, okay, well, your taxes and insurance are this much per year, and we expect you to live for another 10 years. So what they do is they'll multiply their taxes and insurance times 10 and put that, like they call it, set aside. They set aside, like, say, I don't know, $40,000. They just set that on the side and they just say, you can't have this money out of your proceeds because you need that money to pay for your taxes and insurance, but they give you the rest of the money, right? And then no monthly mortgage payment. So you can do stuff like that. The loan application can be denied, but it's really, really hard for them to not give this loan. You have to be, I would say, completely irresponsible and have not enough net equity. Question?
What are the rates on?
Okay, so the rates, they're based on like a couple of different things like LIBOR or Treasury plus a margin. So right now, like on a variable, it's probably like, I say it's about the same as regular mortgages right now, maybe about close to 7, right in there. And a fix right now would probably be about 8. So of course the rates are important, but sometimes like getting to that next meal is more important. So but we're going to get into like variable and fixed. Let's see. Okay, so on this piece, okay, so just the cautions, you got to be 62 years old. And if you're like me, and like I'm 62 right now, so I'm going to marry me a lady that's about 23 or something like that. So I don't know what's going to happen with her, but she can't really be on the reverse mortgage loan with me. But there's potential where they could continue living. Like if they didn't start off on the reverse mortgage, they could still live in the house later after the older spouse passes away. They need to stay current on the taxes and insurance. It's really important. They must stay, because if they get behind, they still can get foreclosed on something like that. But if they're responsible, then they're going to be okay.
Can you rewind a little bit on that, on how it can foreclose on them?
Well, if you get delinquent on your taxes and insurance,
Oh.
yeah, like it's not the bank's not going to foreclose, but
Right.
County will, right? The state will. Okay, and then your primary residence. So that means you need to live there more than, I think, I can't say, I think it's 180 days a year. I think it needs to be 180. Like it has to be more than 6 months. But sometimes people they have to go to the hospital for a while. But you just gotta let the lender know if you have a situation like that, if it's a hardship or something, because you don't want them to start saying, "Oh, now you gotta sell your house and all this good stuff." Okay. All right. Let's talk about before we go to that last slide. Okay, so remember I told you everything's like it's opposite with a reverse mortgage. So in a reverse mortgage, a fixed rate is not the best way typically to do this. And the reason why is if you do a fixed rate, then you only have one option of pulling the money out. You have to pull it all out at one time. So if you have, like, say it's 300 grand, you got to pull out all 300 grand at one time. And then you're like, well, isn't it good that it's fixed? So like the rates don't go up and down. Well, yes or no. Like if you're going to use all that 300,000, like right now, it might be good because all that money's out there. It's going to get charged interest, but you're paying interest on the whole amount of money versus on the variable. Like, let's just say it's 300,000 that you have access to, but you only need 100 right now. Well, if you pull out 100 at the beginning, now you're only paying interest on 100, right? So if you only need to pull out a little bit at a time, then the chances are that you're going to pay less interest in the long run, even though the rate is variable. Okay, that being said, right now, the rates on the variable, because we're based on US Treasury, we're based on LIBOR, coffee, all these different indicators. And those rates right now, they're higher. They're all higher right now because the Fed is trying to get inflation under control. But once inflation gets under control, hopefully those variable rates will come back down. When we do these proposals, we're going to give a breakdown. We're going to say, here's your variable rate, here's your fixed rate, here's your maximum rate. And then we get into, we do it side by side. And then the person who is making the decision on what they want to do, they give you they tell you what you want to do.
I'm just trying to make it full screen if it's possible.
Oh, that's it. That's it. Yeah, that's it.
Okay.
Because I got that has order. Oh, wow, that's weird. I wonder what went back to that.
Okay.
Oh man, that's giving away my joke.
Yeah, can that work?
Oh my God. Well, that was my thing, but okay, those are my buddies. That was our reunion meeting. And we had a lot of time. We had a lot of fun doing our reunion planning. And I go, look, we need to make a memorable picture. So I'm talking him into making that cholo pose. And just cracks me up every time I see that because it's this guy right here, the guy above me, he's making the craziest expression. But anyway, like I know I'm in the front.
It's hard to see.
Yeah, it's a little blurry too. That's weird. That Apo 13. I'm trying to. I don't have any control over this thing right now, but yeah. So I can answer any questions that you have right now, or down the road. Like I know you're not gonna remember all this stuff, but no, you know what? I gave up my gang affiliation. I used to be with the Chopstick Crips, but I would not last. I wouldn't last like 10 minutes in a gang. Like I would make them laugh and everything, but I'm not a fighter. I don't know no kung fu. You know what I mean? All I know is run, fool. And that doesn't help you in the gang. So, oh my God. Okay, well, other that's funny.
Very good. You're right, and I don't remember everything, but we have a good points on this. I should.
I'll email you. I'll email you the PowerPoint,
Yeah.
and then you can pass it around.
Put in your photo.
Yeah, the whole thing's in there. So I don't want you to forget about me, right? That stupid picture. I know every time I show it, like I know my buddies that are one of the guys, he's a counselor at a school, like at an intermediate school, and he's also part of this board or whatever. So I don't know if he like wants me to show that picture, but I don't care. It's too funny.
You see rates coming, I guess, throughout the duration of 2023.
2023, man. Okay, so according to the Fed, it looks like it might go up still, like that rate that affects the prime rate. So it's like prime rates are like 8 right now, right? So it might go a little higher, maybe a 9. But so the good news is if they raise that rate and get inflation under control, it's going to help the mortgage rates. Because mortgage rates, the enemy of mortgage rates is inflation. Because if someone gets a 30-year fixed loan and the rate is like, right now it's like say 7, right? But they think inflation is going to be 8 or something like that, then the people who are funding these loans are like, if we think inflation is going to be 8, why do I want to lend it at 7? You know what I mean? So then they'll raise their rates. But if they get the inflation under control, they think inflation is going to be, the target is 2%, then the people who are, selling the mortgages and investing in the mortgages are like, okay, well, if inflation is 2%, well, we could do it at 4 because we're still making 2%, right? And they have to do that too, because if they don't, then people are not going to want to get mortgages, right? Right. So supply and demand and all this stuff. And that's why
The Fed and the government is trying to constrain the lending environment, access to capital, and trying to reduce, obviously fight the inflation part. So how is that lending restrictions, or do you see any tightening going on in mortgages or higher qualification process in the near future?
Okay, so the question was, if the Federal Reserve and everybody else is trying to get,
They're doing quantitative tightening.
yeah, they're doing quantitative tightening, meaning they're raising the rate that affects business to business lending. They want less money on the street, all this stuff, right? They're trying to do all this to slow the economy down, right? Okay, so then the second part of the question was,
Is this going to impact lending at all? And do you foresee them changing or making higher qualification requirements?
okay, so then the question is it going to affect lending? And then is it going to create harder qualifications for loans, right? Okay, so there's two parts to that. One is the business side, which definitely everything you said about the business side, that's what they're trying to do, tighten it up. They're trying to keep less money out, off the street. They're trying not to, basically they're trying to curtail demand. So with, again, the business side, you're absolutely right. That's exactly on the consumer side, it's half that. So like on regular mortgages, they're not going to create any new qualification restrictions or anything. They're just, people are going to qualify the same way they are right now. If they can make that payment at that rate, then they're good, right? But where it's affecting people is right now, people are trying to take money out of their house, and then they're not doing it with a first mortgage. They're not doing cash out refis and unlocking a 2.5% rate and taking it to 7%, so they could pull, $200,000 out to do something, right? So what people are doing, they're doing HELOCs right now, home equity line of credit. And then the home equity line of credit, that's based on the prime rate. And it could be prime rate plus 0, it could be prime rate plus 2, right? The prime rate's 8. And then they're trying to do a HELOC, and now they're pulling out 200,000 at 8%. Then they're thinking about whether or not they want to pull 200,000 out, right? So if they're going to do something like invest in an ADU or something, it's worth it because they can make money off that, right? But if it's to buy a jet ski, it might be like, oh, I don't want to have an 8% rate on a jet ski. So that's slowing down demand as well. So it's kind of like it's a complicated, multi-tiered situation out there. And the other thing too is like when you're looking at all this, then you don't think about other stuff that's going on in the world too. Like when
Bank failures and
yeah, all that stuff, crypto, all this stuff. So it's not, I'm giving you rules of thumb, but there's always a variable out there. Yeah, I mean, the reason why the rates went down a lot in the first place, when they first went down during the Bush administration, that's when we went into Iraq and we had that big old war. And that caused a lot of people to want to take the money out of the stock market, put it into the bond market for, they call flight to safety, because they were cool to take a smaller return on the money, but the U.S. Treasury is much safer than putting it into, stocks at that time. And that was part of the reason why the mortgage rates went down, because the mortgage-backed securities is very similar to 10-year Treasury bond. We'll get a little technical, but it's like the flight to safety. They feel like mortgages are a very safe investment right now because everybody has to bring in their pay stubs and bank statements and everything else. And it's not like stated income. It's not risky like it used to be. They're not just 125% loans and stated income. You know what I mean? So
switching subjects. Are you familiar with the California Green for All program?
I am.
By
Yeah. Yeah, Cal HFA, that's my phone's been ringing off the hook all week.
Are you getting into it?
Yeah. We're getting into Cal HFA. I was going to talk about it at your next sales meeting next Wednesday.
I know the special qualified members do it.
Mm-hmm.
So one, you can do it.
Yeah.
Can you teach my agents here about this program? Just an overview.
Okay, in a nutshell, what California Cal HFA, what they're doing is they're giving up to 20% to first-time home buyers, but they do what they call equity share. So there's no monthly payment on that. Let's just say for math, $500,000 house, $100,000 down payment comes from Cal HFA. The borrower, it's not a silent second. It's not a traditional silent second where, there's no payback on it, right? Like some of those silent seconds could get forgiven, but this one's not. So what you do is this $100,000 that you have from Cal HFA, it's your down payment money. You don't make any payments on it, but when you sell the house, then they're going to take 20% of the equity gain, right?
Only
So
on gains.
only on the gains. So if you start at 500,000, they give you 100,000, right? That's 20%. You sell that house for 800,000 and you made $300,000 gain. You get to keep 80% of that, and Cal HFA is going to keep 20% of the gain.
Let's just say to get that 800 price, the owner had to spend 100,000 in modeling fees. Do they get to reduce the gains through the capital gains?
Cal HFA doesn't care about that. They only care about the difference. Okay, now I will say this. I want to say this. Okay, so they came out with some guidelines, and the guidelines does not cover a lot of stuff. That's a good question. But the way I understand it, they're just looking at straight, 20% of the sale price. I'll do hell and then I'll get
They
to
are making payments on 80%.
Right.
That also is a Cal HFA loan. As a first, for the 80%,
Mm-hmm.
20% is not a lien, not a second. Are they a title owner?
Yeah, they're definitely on there with you. There's like a disclosure. If you go to the Cal HFA page, there's like disclosures on what it is and how it is. And yeah, they're definitely putting a lien on the house, no question about it. Because they have to, because if you sell it, they don't have a lien, then they're not going to have a way to collect. They're not going to know that.
The first and second.
Yeah, it's definitely first and second, but it's not a traditional silent second like some of those programs. Like I said, some of them get forgiven, some are placeholders, but this one definitely it's smart in a way for the state of California to do it this way, because then they're not going to lose. And if you sell the house, you don't have any gain, then you just pay the money back to them. Hopefully you don't go upside down. Probably not going to happen. Helen?
I have a question. Do you have anything like restriction for that, the income or something like?
Yeah.
20% down payment?
Okay, so the question is there restrictions on income? Yes. So the AMI, that average median income for the area, there's it depends on the county. There's a lookup tool, and it goes county by county on how much you could make. Yeah, so and as first time home buyer, right? So yeah, so the question is, if they have their own 20%, and then can you borrow 20% from Cal HFA? Not the full 20% on your side. The maximum could be 70 LTV on the first mortgage. So you could bring in 10%, they bring in 10%. Yeah, and use the other 20%, the other 10%, just keep it in the bank. And I feel like I'm at the White House right now. I'm like, but hopefully I know all the answers. Edgar. Okay, so there's you don't have to be a U.S. citizen, but there's some different there's like a breakdown in the website. We can find out about I-10. I don't think so. I-10 might be hard because the first mortgage lenders, it's tough. And then this Cal HFA first mortgage, other like brokers and everybody, we have access to theirs, which is through this company called Lakeview. And then some of our other lenders are also now coming and tell us that they could do the Cal HFA loan as well. But me as a broker, I'm just putting the deal together. Yeah. We can find out about the I-10.
good program.
It's not a dream for all.
Dream of homeowners.
It's a dream for some.
Yeah, it's definitely not the dream for all because like I had this buddy of mine, he lives up Northern Cal somewhere, like Lodi or something. Anyway, he makes more than the AMI. Like, so he can't qualify for it. And then like San Bernardino and Riverside County, their AMI is lower than, LA and Orange County. So like one of them, they were talking about doing it. The husband and wife can't do it together because they make too much money. So there's like, it's definitely not a dream for all. And the other thing too is the funding of it. This money's going to go fast. It's going to go fast because 20% nowadays on any house is going to be what? 800 grand, 20% is 160 grand. Right, just like conventional loans. Conventional. So it's typically 620.
Is 180,000 income limit?
Yeah.
That's a lot. 80% of the people fall in that category.
Yeah, but it depends on their debt. I mean, I run numbers and some people, they have a lot of debt. They got student loans. They got different things. So sometimes it doesn't work out. But definitely bringing 20% into a deal like this, it's a game changer. No question about it. But they're going to run out of money fast on this. So if you have clients that are looking to do something like this, you need to like get them in, before they run out of money. I don't know how long I've gone, but I feel like I went way over time. But I mean, I'm cool to go if you're cool to go.
Questions, guys?
No, you did a great job.
Oh, thanks.
Absolutely. I think you touched on a lot of areas.
But the main thing was the reverse mortgage today.
Yeah.
It's like thinking outside the box. If you can put a postcard out there and like Angie could get you the farm of people who are at that age level. And, you never know what they're looking at, right? Like I said, everybody's like, oh, I saw your house fast. I'll sell your house for this or that, or, whatever. But not too many people are talking about this right now. And that could help you potentially if you're already farming.
All right, let's give them a round of applause.
All right, thanks. Thanks, everybody. Thanks for letting us do it. All right, bye.
Thanks, guys, for being here with us on Zoom. I hope you enjoyed it. I'm going to stop the recording.
And I guess the fun fact for Scott